Ever wondered how investors spot the next big stock? Or how some people seem to pick winning companies while others struggle? Today, we're diving into the world of fundamental analysis, your ticket to understanding the value behind the numbers and making smarter investment decisions. So grab your coffee and let's break it all down in simple terms. What is fundamental analysis? Fundamental analysis is all about understanding the true value of a company. Instead of just looking at stock prices or trends, we dig deeper into financial statements, market conditions, and even the company's management. You analyze the business itself. It's like being a detective, solving the mystery of whether a stock is undervalued or overvalued. All right, let's start with the essentials. Every company has three key financial statements, and they're like the heart, lungs, and brain of the business. First, balance sheet, the financial snapshot. The balance sheet shows what a company owns, assets, owes, liabilities, and what's left for shareholders, equity. It's like a snapshot of the company's financial health at any point. Key metrics to focus on are current ratio. This measures liquidity, or the company's ability to pay off short-term debts. Current assets divided by current liabilities. A ratio above 1 is generally good. Debt to equity ratio. This tells you how much debt a company uses compared to shareholder equity. A ratio below 1 often indicates financial stability in time. Second, income statement, the profit and loss story. The income statement is where you find out if a company is making money. It details revenues, costs, and profits over a specific period. It includes net income, the bottom line that shows how much profit the company keeps after all expenses. Earnings per share, how much profit is allocated per share. Net income divided by outstanding shares. A higher EPS indicates greater profitability. Third, cash flow statement, the cash machine. The cash flow statement tracks how cash enters and exits the business. It's the best way to see if a company can pay its bills and invest in growth. Look for free cash flow, the cash left after expenses. Positive free cash flow is a sign of financial health and flexibility. Key metrics and ratios. First is the price to earnings. The price to earnings PE ratio tells us how much investors are willing to pay for $1 of a company's earnings. It's a simple way to measure whether a stock is overpriced or a potential bargain. PE ratio equal to stock price divided by earnings per share. If a stock price is $50 and the EPS is $5, the PE ratio is 10. This means investors are paying $10 for every $1 the company earns. Low PE ratio could mean the stock is undervalued, great for value investors. High PE ratio might indicate strong future growth expectations, but beware of overvaluation. Always compare PE ratios within the same industry because different sectors have different benchmarks. A tech company may naturally have a higher PE than a utility company. Second key point is the return of equity. The return on equity, ROE, measures how efficiently a company uses shareholder money to generate profits. It's like asking, for every dollar I invest, how much profit will I get back? Return on equity equal to net income divided by shareholder equity multiplied by 100. Example, if a company earns $200,000 in profit and has $1,000 in equity, its ROE is 20%. This means it generates 20 cents in profit for every $1 invested. High ROE indicates efficient management and strong profitability, often a good sign. Low ROE could mean inefficient use of capital or trouble generating profits. Compare ROE with industry peers. A retail company's healthy ROE might differ significantly from that of a bank. Third key point is dividend yield. The dividend yield is a favorite for income investors because it shows how much return you're getting from dividends compared to the stock price. Think of it as the percentage of your investment returned to you as cash each year. Dividend yield equal to annual dividend per share divided by stock price and multiplied by 100. Example, if a stock pays a $2 annual dividend and its price is $50, the dividend yield is 4%. High dividend yield can be attractive, but investigate whether it's sustainable. A very high yield might signal trouble, e.g., the company is paying more than it earns. Low dividend yield might indicate growth-focused companies reinvesting profits instead of paying dividends. Look for consistent dividend-paying stocks if you want steady income, but balance it with growth opportunities. Fourth key metrics is debt-to-equity ratio. The debt-to-equity ratio tells us how much debt a company is using compared to shareholder money. It's like asking, is this company borrowing too much, or is it financially stable? Debt-to-equity ratio equal to shareholder equity divided by total liabilities. Example, a ratio of 0.5 means the company has 50 cents in debt for every $1 of equity. A ratio of 2.0 means it has $2 in debt for every $1 of equity. Low ratio, the company relies less on debt, good for stability. High ratio could mean higher financial risk, but might also indicate aggressive growth strategies. Balance is key. Look for companies that manage debt responsibly while funding growth. And fifth key metrics is free cash flow. The free cash flow, FCF, shows how much cash is left after a company pays for its operating expenses and investments. It's a clear measure of financial health and flexibility. Free cash flow equal to operating cash flow minus capital expenditures. Example, a company generates $500,000 in operating cash flow and spends $200,000 on equipment. The leftover $300,000 is its free cash flow. Positive FCF. The company has money to reinvest, pay dividends, or reduce debt. Negative FCF could signal high investment costs or poor cash management. Positive free cash flow over time is a strong indicator of a company's long-term sustainability. Avoiding common pitfalls. Watch out for pitfalls like comparing ratios across different industries. Always stay within the same sector. Ignoring red flags like inconsistent revenue or rising debt. Thinking short-term, fundamental analysis works best for long-term investing. Combine fundamental analysis to find strong companies with technical analysis to time your trades. Together, they can help you make better investment decisions. Investing isn't just about following trends, it's about understanding the value behind the numbers. With fundamental analysis, you can make informed decisions and build wealth over time. Ready to take control of your investments? Subscribe for more insights and let us know your favorite investing tip in the comments.